and I'm a Senior Employee Benefit Consultant here at Drewberry. Today we're going to talk about workplace pensions, what a pension is, the legislation that surrounds it, and how it's beneficial for your employees. So what is a workplace pension? Essentially, it's a key benefit to help your employees save for their retirement. You as an employer are required to set up a suitable workplace pension scheme and enrol your employees into it. And there are also certain levels of contributions that must be paid both by you as the employer on behalf of your employees and by your employees. And the idea is that this builds a fund which will be their income to see them through their retirement. So automatic enrolment is the process whereby you have to enrol your employees into a suitable workplace pension scheme. There are certain criteria for your employees to be automatically enrolled. They have to be between 22 years of age and state pension age and earning at least £10,000 per annum and usually based and working in the UK. It's worth bearing in mind that your employee doesn't have to stay in the pension scheme. They do have the right to opt out if they wish, but if they meet that criteria, you must enrol them into the scheme and pay a certain level of contributions. In addition to that, if your employees don't meet that criteria, if they're below 22 years of age or above state pension age or earning less than £10,000 per annum, they can still opt into the pension scheme, and if they elect to do that, you must again submit a certain level of contributions on their behalf. Now, there are certain legal obligations that you must meet as the employer in order for your scheme to be a qualifying workplace pension scheme. We've talked about the employees that you have to automatically enrol, and also there are certain levels of contributions that must be met, which we'll talk about shortly. The other main criteria for your scheme to be a qualifying workplace pension scheme is that the annual management charge must be below 0.75%. The other thing that you're required to do is to re-enrol any employee that has opted out, and that has to be done every 3 years. This is known as your triennial re-enrolment date. Now, communication is key as part of your workplace pension scheme. There are some mandatory communications that you must issue as part of the legislation, but also it's important to promote your pension scheme so the employee is aware of the value they're getting from it. If we look at the mandatory communications, there's a couple that you must do. So if you operate a postponement period before you enrol employees into the scheme, you must send what's called a postponement notice to the employee to inform them that you're effectively deferring their enrolment into the scheme. It's worth bearing in mind that that should be issued within 6 weeks of the employee's start date, and they do have the option to opt in upon receiving that notice. As well as that, you have the enrolment notice. Now, this should be issued within 6 weeks of the employee's enrolment date into the scheme, and this will give information on the scheme, for example, who the provider is, the contribution structure, what you'll be paying as the employer, what the employee will be expected to pay, and it will also tell them they do have the right to opt out of the scheme if they wish. So these are mandatory notices, and it is important that you issue these to employees within the required timeframes. Now, there are basically two types of workplace pensions. You've got defined benefit schemes and defined contribution schemes. Defined benefit schemes are less popular now because they're very expensive for the employer to run, but effectively they're linked to the employee's salary and length of service. The other option is the defined contribution scheme, which is where you as the employer pay a contribution on behalf of the employee pays a contribution, that goes into a pension fund, which is the individual's income to see them through their retirement. Now, in terms of defined contribution schemes, there are really two types. You've got trust-based schemes and contract-based schemes. With a trust-based scheme, it's managed by a group of trustees on behalf of its employees and is separate to the funds held in the business. There are also master trust providers such as Nest that can have multiple employers using that trust at the same time. In terms of contract-based schemes, this is essentially an arrangement between the employee or the individual and the pension provider. And the most common type of contract-based scheme will be a group personal pension, where you have a group arrangement, but each individual has their own plan within that group arrangement. And these are very commonly used for workplace pension schemes. Now, we've already mentioned there are certain legal obligations that you must meet as the employer in order for your scheme to be qualifying. One of those criteria is to submit a certain level of contributions. Now, that's 8% of the employee's qualifying earnings or their basic salary. Of that 8%, as the employer, you're required to submit a minimum of 3%. If you choose to do the minimum, the employee would be required to pay 5%. It's worth bearing in mind that you can pay more than 3% if you wish. So for example, if you wanted to make an employer contribution of 6%, the employee would only be required to pay 2%, as long as that 8% is met. It's also worth bearing in mind that the employee does have the option of paying more than 5% if they wish. And if they pay more than the 5%, you as the employer are not required to pay more than your minimum contribution. Now, we've already looked at the fact that setting up a workplace pension scheme on behalf of your employees is a legal requirement, but of course there will be costs associated with that. So from your perspective as the employer, the sort of costs that you might want to consider are set-up fees, ongoing administration fees. Your payroll provider also may charge a fee if they're managing the plan on your behalf, and of course the biggest cost to you as the employer is the level of employer contributions that you're going to have to make on behalf of your employees. So you might always want to consider that when looking at budgeting for forthcoming financial years. Now, in addition to any charges or fees that you may incur as the employer, there will also be a charge for the employee, and this is deducted from their individual plan within the scheme. There are two types of charges that can be deducted: an annual management charge or a policy fee, and it's usually taken from the value of the employee's fund. So if we look at the annual management charge, for example, if the employee has £100 invested in their pension plan and the annual management charge is 0.5%, it means that the pension provider will deduct 50p annually to cover their costs. So that's the way the pension provider makes their money. But it's also worth noting that there's no direct charge for you as the employer from the pension provider. It's always deducted from the employee's plan within the scheme. So pension contributions are a tax efficient way of saving. That means that when employees make personal contributions into the scheme, they receive tax relief on those contributions. Now, there's a couple of ways in which this can be applied. There is the net pay method or the relief at source method, and the relief at source method is generally the more popular method. The way it works is that the contribution is deducted from the employee's pay after tax and national insurance has been taken. So it's effectively taken from their net pay. That then gets paid across to the pension provider. The pension provider adds basic rate tax relief to that contribution, and then the gross amount gets applied to the member's plan. Now, to give you an example of the way that works, if the gross contribution is going to be £100, it means that £80 is deducted from the employee's salary. That gets paid across. £20 then gets added in the form of tax relief, meaning that the total allocated is £100. Now, it's worth bearing in mind that it's only basic rate tax relief that gets added to the contribution. So if you have higher or additional rate taxpayers, they will need to reclaim a further 20 or 25% back as part of their self-assessment. Now, there is an alternative method for making personal contributions to a pension scheme that you might be familiar with. It's called salary sacrifice, also known as salary exchange. You might have heard of either term, but they do mean one and the same thing. Now, the way that salary exchange works is effectively the employee is reducing their salary in favour of a pension contribution. There's a couple of advantages to that. From the employee's perspective, because they're reducing their salary and therefore paying less tax and national insurance, it can either mean that their take-home pay increases slightly, which is known as simple salary exchange, or alternatively, that saving can then be paid back into as a pension contribution to increase their pension contributions, which is known as smart salary exchange. That's the advantage from the employee's perspective. From the employer's point of view, it also means that you're saving on employer national insurance because you're not paying national insurance on the element of the salary that the employee is giving up in favour of that pension contribution. So we've looked at what a pension is, and we've looked at the legislation around workplace pensions and how a pension scheme benefits your employees. But a key aspect of this is communication. We believe that it's really important to communicate the pension scheme to your employees so that they understand it and get the value from it. And there's a number of different ways in which we can support with that. We can produce bespoke communications on any aspect of your pension scheme that can then be shared with employees. We can run pension presentations virtually, so employees can join, and we can cover all topics relating to pensions. And we can also hold one-to-one pension surgeries, so employees can meet us, they can ask us any question on their own pension scheme or any questions they have about pensions in general. All of these aspects go to help the employee understand their pension scheme and ultimately support their financial well-being, which hopefully will mean that they are fully prepared for a comfortable and long-lasting retirement.